Hi guys, so I welcome you all to today's lecture under the fast track series for RBI Grade B 2018, which has been brought to you guys by EduTap. Before proceeding forward, let us briefly look at what this series entails for you guys. So in this particular series, we are going to attain a comprehensive coverage of current affairs from the month of May 2018 to 15th August 2018, that is before your examination. And again, in this particular series, we are going to alternatively cover topics of ESI, that is economic and social issues, and finance and management, which will be covered through important problems under multiple choice questions or MCQs. Now, we have been working in this direction for the past few years, and we have been blessed with some of the very amazing results in the past few years. Now in RBI Grade B 2017 results, 124 of our students, they reached the interview stage, and 27 of the students, they made it to the final list. Now apart from the different other courses which we are running, we are offering these courses for RBI Grade B 2018 examination. So these are the different courses which you guys can choose from. So there is a wide range of courses and you can choose according to your requirement. Also, we are running presently discounts on the EduTap courses. So the subscribers of 2017 courses, they can get a flat 30% discount. And for this, they have to drop a mail at deepak@edutap.co.in. And the new subscribers, they can get a flat 20% discount using the coupon code of 20. Now, in case you need to know more, you have any query, you can always visit our website, which is www.edutap.co.in, or you can drop us a mail at deepak@edutap.co.in, or you can call us at 8146-207-241. In this particular video, we are going to look at some of the very important MCQs based on the Economic Survey 2018 Volume 1. So let's start with the first question. Which of the following is incorrect regarding the new facts as brought out by the Economic Survey 2017-18? Now the Economic Survey 2017-18 has brought out 10 new facts regarding the Indian economy, and this is in continuation with the facts which were brought by the previous Economic Survey. Now in this question, we are required to identify the incorrect fact as per the current Economic Survey. The options are: there has been a large increase in registered indirect and direct taxpayers. Formal non-agricultural payroll is much greater than believed. India's firm export structure is substantially more egalitarian than in other large countries. It means India's firm export structure is more equally distributed than other large countries. Indian society exhibits strong sun meta preference. To reignite growth, raising savings is more important than raising investments. So for answering this particular question, we must be aware about the 10 new facts which have been brought by the current Economic Survey. So these are the 10 new facts on the Indian economy as brought out in the survey. So these are: there has been a large increase in the registered direct and indirect taxpayers due to introduction of GST and demonetization. So after demonetization, number of income tax or direct taxpayers have increased, and after introduction of GST, the number of indirect taxpayers, the registered taxpayers, they have increased. Formal non-agricultural payroll is much greater than believed. So it means that people who are not involved in agriculture, they are employed elsewhere, their number in formal sector is much more than 30% in terms of social security provision. If we look at the people, the entities which are registered under the EPFO, Provident Fund, or Employee State Insurance, then this is 30% more. And if we look at the entities which are there in the GST net, then this payroll is 50% more. So crux is formal non-agricultural payroll is much greater than believed. States that export more internationally and trade more with other states, they tend to be richer. So if the states, they are exporting both outside the nation and within the nation to other states, they are going to be rich states. India's firm export structure is substantially more egalitarian than in other large countries. Top 1% of the India's firm accounts for 38% of the exports, and in all other countries they account for a substantially greater share. So India's exports are more equally distributed, and it is not like the top 1% has acquired all the share in the exports. They have only 38% share, and the rest goes to other firms in the country. So India's export structure with regard to firms is more equally distributed than the other large countries. The clothing incentive package of 2016, which was introduced by the government, has boosted the exports of ready-made garments. So this is another key fact. Indian society exhibits strong son meta preference. Parents continue to have children until they get the desired number of sons. So this is the gender bias which has been brought out by the survey. There is substantial avoidable litigation in the tax arena which the government action could reduce. So there are huge number of cases, legal cases, which are pending in the courts of law. So the government can take action and it can reduce those tremendous amount of cases. To reignite growth, raising investment is more important than raising savings. So this is important, that we need to focus more on raising investment than on raising savings, because ultimately investment are going to contribute to the economic growth and development. Also, cross-country experience shows that growth slowdowns are preceded by investment slowdowns, but not necessarily by saving slowdown. So, if there is a slowdown in investment, it may happen that there may be a growth slowdown in the future. However, in case of a saving slowdown, there may not be any growth slowdown in the future. So, investment slowdown is the key area of concern for any economy. Own direct tax collections by Indian states and local governments are significantly lower than those of their counterparts in other federal countries. So if you talk about the direct tax collections, these are very low for Indian states. The footprint of the climate change is evident, and extreme weather adversely impacts the agricultural yields. So this is with regard to the effects of the climate change, which can adversely impact the agriculture scenario of the country. So now we can easily answer this question, that as per the 10 new facts which have been brought out by the economic survey, this E statement is going to be incorrect, because to reignite growth, raising investment is more important than raising savings. So answer to this is going to be option number E. Now move to the next question. As per the economic survey 2018, as these twin reforms take hold, firms should finally be able to resume spending, and banks to tend to lend especially to the critical but currently stressed sectors of the infrastructure and manufacturing. So this is the line which has been taken from the economic survey 2018, and this is talking about some twin reforms which are going to influence the firms as well as the banks in the country. So the question asks, which of the following twin reforms are being talked about here? Options are implementation of demonetization and Jan Dhan Yojana, insolvency, Indian bankruptcy code and insolvency and bankruptcy code, and recapitalization package for banks, introduction of GST and incentive package for textile sector, commitment to fiscal consolidation and restrictions on gold imports, or none of the above. Now the economic survey carries forward the discussion which has been started by the previous version of the survey with regard to the twin balance sheet problem. Economic Survey 2018 says that decisive actions have been taken to grasp the nettle of twin balance sheet challenge, that is to tackle this particular challenge. Now this twin balance sheet problem, it was first introduced in the Economic Survey 2015-16, and this means that the public sector banks and the corporate houses, both their balance sheets are under stress. Now how this happened? During the boom years in the economy, some companies started borrowing a lot of money from the banks in the hope that they are going to invest this money in the infrastructure or any other commodity related businesses. But later on, what happened? The economy went into slump. So the business houses, they were not able to repay the money to the banks. As a result, the balance sheet of both the business houses and the banks, it came into trouble, and this is known as twin balance sheet problem. The Economic Survey 2018 says that the twin reforms in the form of Indian Bankruptcy Code or IBC and the recapitalization package for banks, these twin reforms have played a key role in tackling the twin balance sheet challenge. Now the Bankruptcy Code, it is providing a resolution framework that is going to help the corporates or the companies which borrowed a lot of money to clean up their balance sheets and reduce their debts. So this is going to clean up the balance sheet of the companies and the recapitalization package for the banks which has been announced by the government, and this is going to help in strengthening the balance sheet of the public sector banks. And the survey says as these twin reforms take hold, firms should be able to resume spending and the banks should be able to again lend the money to critical and the stretched sectors of infrastructure and manufacturing. So these are the twin reforms, IBC and a recapitalization package, which we must remember. So now we can easily answer this one. Answer to this is going to be IBC and recapitalization package. So the answer is option number B. Now let's move to the next question. According to Economic Survey 2017-18, which of the following groups would prefer high interest rates in an economy? Options are service exporters, domestically oriented firms, households, infrastructure companies, domestic equity investors. So this is the table which has been presented in the economic survey. So it talks about the group and the preference of the group and the reasons for this preference. So it says that manufacturers, service exporters and farmers, they are going to prefer low interest rates and weak currency. Why? Because with the low interest rates they can borrow money and their borrowing cost is going to reduce and the profits they are going to earn, they are going to increase. And if there are service exporters will be happy if the currency rate is weak because they are exporting their services and they are earning in foreign exchange, so they are going to get more Indian currency for same amount of foreign currency with weak currency. However, there is an exception, which is import intensive manufacturers. So manufacturers who have to import a lot of capital goods or other inputs, they will prefer stronger rupee, stronger currency rather than weak currency because they are going to spend a huge amount of foreign currency. Domestically oriented firms, the firms which are domestically oriented, they are going to focus on low interest rates because then again this is going to increase their profits. And infrastructure companies, they are going to focus on strong currency and low interest rates. This is because the infrastructure companies, especially power and renewables, they have typically imported capital equipments, and this is financed with the foreign currency loans. So they have imported capital goods from abroad, and if the currency is strong, they can easily import those goods and they can easily make payment for those. And the low interest rates reduce the debt service burden on domestic loans. So this is why. Next comes the households. They are going to prefer high interest rates because they are going to put their money in the banks and financial institutions. And the equity investors of domestic, they are going to prefer low interest rates because the companies in which they are putting their money in the form of shares, they are going to have higher profits due to reduced borrowing cost. And similar is the case for the foreign equity investors, but they are also going to prefer strong currency. And then comes the bond investors, domestic, they are going to prefer falling interest rates because the falling interest rates, this generates capital gain. Now there is an inverse relationship between the bond prices and interest rates. This we have already discussed in one of the fast track lectures on finance. And the bond investors foreign, they are going to prefer high but falling interest rates and a stronger currency. The government is going to prefer a low interest rate because this is going to reduce its borrowing cost. And the non-economic actors, they are going to prefer strong currency because strong currency is equated with national economic strength. So now we can answer this question easily, that out of all these options, households are the one which are going to prefer high interest rate in an economy. So answer to this is going to be option number C. So now let's move to the next question. If NSSF or the National Small Savings Fund net flow increase for any given fiscal deficit, then which of the following would be the likely impact on market borrowings? Options are market borrowing would increase, market borrowing would decline, market borrowing would remain unchanged, cannot be determined, or none of the above. Now to answer this question, we must have some basic understanding about the National Small Savings Fund and how this is related to the fiscal deficit. Now Economic Survey 2018 states that the government, it gets deposits from the public independent of its deficit induced borrowings. So if the government incurs a fiscal deficit or if the expenditure of the government is higher than its non-debt receipts, then the government must finance this money from somewhere. And apart from the borrowings which the government undertakes to meet this shortfall, there is this inflow in the form of National Small Savings Fund, which helps in meeting the fiscal deficit of the government. So this National Small Saving Funds, this is in the form of the money which is put by the public in the various saving schemes, and this is helping in meeting the fiscal deficit of the government. So ultimately the net market borrowings of the government reduces, and the net market borrowings of the government, they are fiscal deficit minus the inflows which we have received from the National Small Savings Fund. So if the NSSF net flows increase for any given fiscal deficit, so the market borrowings would decline, and vice versa. Now let us briefly look at the National Small Savings Fund. This was established in 1999 within the Public Account of India for pooling the money from different small saving schemes, and the objective was to dealing the small savings from Consolidated Fund of India. This fund is being administered by the Government of India, Ministry of Finance, and the schemes which are there under the National Small Savings Fund, they offer competitive interest rates, risk-free investments, and also tax breaks. So they are very attractive for the investors, and the flows in the NSSF are autonomous, and they are not determined by the size of fiscal deficit, by their perceived attractiveness due to all the features which are attached to these National Small Saving Funds. So now we can easily answer this question, that if the NSSF flows increase, the market borrowings would decline. So answer to this is going to be option number B. So now let's move to the next question. According to Economic Survey 2018, which is the largest importing state in India. So this is a factual question directly picked from the Economic Survey. Options are Maharashtra, Uttar Pradesh, Haryana, Tamil Nadu, and Karnataka. Now with regard to internal trade scenario in India, Economic Survey 2018 says that India's internal trade in goods and services is even higher than suggested by the last year's survey. So this is very positive for the internal trade scenario in the country. And further, the Economic Survey raises two very interesting questions. These questions are the states that export the most are also the ones that are importing the most? So if the state that has highest exports, is it the same states that is going to have the highest imports? And next, are the states that trade the most the ones that are most competitive and they have largest trade surpluses? So the states which are trading the most, they are most competitive, and are they running the largest trade surpluses? So these are the two questions which have been raised, and the survey answered these questions in the affirmative. It says yes, this is so. So the states that export the most are the ones that are importing the most, and similarly the states that are active traders, they have large trade surpluses and they are competitive states. Now survey with regard to this provides these important findings. The 5 largest exporting states, they are Maharashtra, Gujarat, Haryana, Tamil Nadu, and Karnataka, and the 5 largest importing states are Maharashtra, Tamil Nadu, Uttar Pradesh, Karnataka, and Gujarat. And the states with the largest internal trade surpluses, they are Gujarat, Haryana, Maharashtra, Odisha, and Tamil Nadu. So you can see large number of overlaps between the names of the states in all these 3 important findings because of the questions we just addressed in the previous slide. So this is the state's share in the interstate trade and the net exports. So you can see in terms of exports, Maharashtra is on the top, and in terms of imports, again Maharashtra is in the top, and in terms of net exports, this is Haryana which is on the top. So now we can easily answer this question, that according to Economic Survey 2018, which of the following is the largest exporting state in India? It is option number A, Maharashtra. So now let's move to the next question. According to Economic Survey 2018, the ratio of gross fixed capital formation to GDP in 2017 as compared to 2007 has, options are increased, declined, remained constant, increased drastically, or none of the above. Now the Economic Survey 2018, it has brought out some interesting trends with regard to savings and investment cycle in the economy. Let us look at these trends one by one. So first one, it says the ratio of the gross fixed capital formation to GDP, or the ratio of investment to GDP. It has climbed from 26.5% in 2003. It reached a peak of 35.6% in 2007, and then again it declined to 26.4% in 2017. So this also you can see from here that the investment at first increased and it reached the high levels in 2007, and ultimately it started declining. And with regard to the domestic savings, it says that the ratio of domestic saving to GDP has registered a similar evolution. It again rose from 2003 to a peak of 38% in 2007, but then again it declined to 29% in 2016. So this dotted red line, it shows the journey of the savings. So you can see it increased and ultimately it started declining from 2007 onwards. And it says that the cumulative fall over 2007 and 2016 has been milder for investment. So investment has stayed at a lower level. The fall has not been much. However, for savings, the fall has been greater. So it says that the cumulative fall has been milder for investment than saving, but again investment has fallen to a lower level. So investment is at a lower level as compared to savings. So on the basis of these findings, now we can easily answer this question that the ratio of gross fixed capital formation or investment to GDP in 2017 as compared to 2007 has declined. So answer to this is going to be option number B. Now let's move to the next question. Which of the following expressions has been used by the Economic Survey to emphasize the point that taxation is the economic glue that binds the citizens to the state in a necessary two-way relationship? Options are no taxation without authority, no taxation without representation, no business growth without efficient taxation, good and simple tax, or none of the above. Now Economic Survey 2018 has brought out this expression that no representation without taxation. The survey says a citizen's stake in exercising accountability with regard to the government, it decreases if that citizen is not paying in a visible and direct way for the services that the state has committed or state is obliged to provide. So if the citizen is not paying any taxes or is not paying in any direct manner, that citizen becomes a free rider and he does not have any standing with regard to complaining with regard to the poor quality of services which are being provided by the state. Only if the citizen is paying for the service which the state is bound to provide, then only he can exercise the accountability with regard to the state, and hence the expression no representation without taxation, or the taxation is the economic glue that binds the citizens to the state in a necessary two-way relationship. So now we can easily answer this one, that the expression no taxation without representation has been used by the Economic Survey in this regard. So answer to this is going to be option number B. Now let's move to the next question. According to Economic Survey 2018, which of the following components of investment accounts for most of the decline in overall investment decline over 2007-8 and 2015-16? So it says that though investment has declined from 2007 to 2016, but which of the following components has contributed the most to this decline? Options are public investment, household investment, private investment, all contribute equally, none of the above. Now Economic Survey 2018, it brought out the following picture with regard to savings and investment in the country over the past few years. So it says that the sectors responsible for the savings and investment decline in India, they are private investment and household government saving. So this is the table which has been brought out. So it says from 2004-5 to 2007-8 to 2007-8 to 2015-16, this has been the change in investment, and similarly the change in the saving. So now the investment has declined if you look at the latest period, and you can see that the sector which is contributing the most is the private investment. And with regard to the change in savings, you can see again there is a decline, and the sectors contributing to this are most is the household and the public or the government saving. So the survey says that out of the total investment decline from 2007-8 to 2015-16, there is a 6.3% decline in the overall investment, and private investment accounts for 5% of this decline. And with regard to savings, it says that the 8 percentage points decline has been driven almost equally by fall in household and the public or the government savings. And it says that the fall in household savings has in turn been driven by the fall in physical savings. And it says that there has been a shift from currency and bank deposits towards market instruments, that is shares and debentures, in the financial savings front. So now we can easily answer this question that private investment has contributed to the maximum decline in the overall investment over 2007-8 and 2015-16. So answer to this is going to be option number C. So now let's move to the next question. According to Economic Survey 2018, in the last few seasons, the farm revenues have declined for a number of crops despite increasing production, and the market prices have fallen below the minimum support price. This has been referred to as, the options are natural resource curse, cry of the wolf trap, food crisis in the making, problem of plenty, or none of the above. Now the economic survey, it talks about the problem of plenty. It says that though the last few seasons they have witnessed increase in the production, but the market prices have fallen below the minimum support price, and the farm revenues have declined for a number of crops. So despite increasing production, the revenues have declined. This is the problem of plenty. So the production has increased, but the market prices and the farm revenues, they have declined. So now we can easily answer this one, that this phenomena has been referred to as the problem of plenty, and the answer to this is option number D. So now let's move to the next question. According to Economic Survey 2018, sex ratio of last child of close to 1.05:1 would imply that options are strong son meta preference exists in the society, parents' decision to continue having children is uncorrelated with the previous birth being son or a daughter, strong daughter meta preference exists in the society, female infanticide is rampant in the society, or none of the above. Now the economic survey has brought some interesting insights with regard to son meta preference, which it says that exists in the Indian scenario. So it says that there is a strong son meta preference. So it involves parent adopting fertility stopping rules, and they mean that they continue to have children until the desired number of sons are born. Now this leads naturally to the notional category of unwanted girls, which is estimated at over 21 million. So there are 21 million unwanted girls in the country. Now in some sense this means that once born, the lives of the women are improving, but the society still appears to want fewer of them to be born. So with regard to this preference, it says that one indicator that potentially measures this preference is the sex ratio of the last child. A preference for sons will manifest itself in the sex ratio of last child being heavily skewed in favor of the boys. On the other hand, if this ratio is close to 1.05:1, this means that the parents' decision to continue having children is uncorrelated with the previous birth having a son or a daughter. So now we can easily answer that a sex ratio of last child of 1.05:1, it implies that parents' decision to continue having children is uncorrelated with the previous birth being a son or a daughter. So answer to this is going to be option number B. Now let's move to the next question. Yes, we have put an additional question in this one. Until early 2016, India's growth had been accelerating, when growth in other countries was decelerating. But when the converse happened, the world economy embarked on a synchronous recovery, but India's GDP growth decelerated. Economic survey terms this as, options are curse of the resources, twin balance sheet challenge, decoupling of the Indian growth from the global growth, cry of the wolf trap, or none of the above. Now the Economic Survey 2018, it says that until early 2016, India's growth was accelerating, but the growth in the other countries, it was decelerating. But then the converse happened. The situation reversed. The world economy, it started on a path of recovery, but India's GDP growth, it started declining. So this has been termed by the economic growth as the decoupling of the Indian growth from global growth. And for this decoupling, Economic Survey has also presented some of the reasons. So these are the reasons. So it states that the India's monetary conditions, it decoupled from the rest of the world. And it says that the demonetization and GST, the one-off policy actions, have also contributed to this. And it also says that another factor was the twin balance sheet challenge, which was exerting a drag on the Indian economy. And then the final factor was oil prices. Now in the last 3 years, India experienced a positive in terms of a trade shock, but in the first 3 quarters of 2017, oil prices have been greater. So this is influencing the GDP growth of the Indian economy. So now we can easily answer this one, that the answer to this is going to be decoupling of the Indian growth from the global growth. That is option number C. Now before winding up our discussion with regard to Economic Survey 2018, let us also briefly look at some of the key figures and facts with regard to the Economic Survey that have been brought out in these charts. So with regard to GDP growth, the Economic Survey says that the GDP growth in 2017-18 is expected to be 6.75%, and as per the first advanced estimates, this is around 6.5%. So you can clearly see the trends with regard to this. The GDP growth is on decline since 2015-16. With regard to industrial growth, it says that this industrial growth is going to remain around 3 to 4% level. And with regard to fiscal deficit, it states that the fiscal deficit as a percent of GDP is gradually declining, 4.9 to 3.9 to 3.5 to 3.2% as estimated in the Union Budget for 2017-18. With regard to inflation, you can see that the CPI average inflation is more or less constant but declining in a constant pattern. However, with regard to WPI, the decline has been a bit more erratic. You can see first it declined, it became negative, and then it again started rising. Total level, the overall level for both these is around 3%. And this we have to remember in terms of the target which has been presented after the monetary policy framework, which is 4 plus minus 2%. With regard to export growth, the pictures which have been presented, they show that the export growth was negative in 14-15 and then again in 15-16, and it has started getting positive from 2016-17 and is expected to increase in 2017-18. With regard to forex reserves, the picture is again positive, and the forex reserves are gradually rising, and they have crossed the $400 billion as per the figures available in December 2017. So guys, here we end our discussion on some of the very important MCQs on the first volume of the Economic Survey 2018. Thank you guys. If you found this video useful, please like the same and share it with your friends. And for more similar videos, please subscribe to our channel on YouTube. Thank you.